99% of investors never build real wealth, not because they pick the wrong stocks, but because they're playing the wrong game entirely. There's a simple shift in how you approach investing that separates the 1% from everyone else, and almost nobody talks about it.
Welcome to The Explainer. Today, we are diving into a question that, let's be honest, trips up almost everyone. How do you actually build long-term wealth? We're going to break it all down using a super simple but really powerful idea I call the investment pyramid.
But first, let's start with a hard truth. See this number? 99%. That is the percentage of investors who, according to a lot of market data, fail to build any kind of significant, lasting wealth. You heard that right. For every one person who really succeeds, 99 fall short. It's a pretty shocking statistic, and it really begs the question,
what separates that successful 1% from everybody else? Well, it's not about being some kind of genius. As the legendary investor Charlie Munger famously said, investing is only about 1% intelligence and 99% temperament. It's all about how you act, how you behave.
Okay, so let's dig into why so many people struggle. It really comes down to this. They approach investing with what I call an upside-down pyramid. You know, they're trying to build their entire financial future from the top down on a tiny little point that is absolutely guaranteed to collapse. Does this sound familiar? The very first question most people ask is about the what. Hey, what's the hot new stock? What fund is everyone talking about on TV? The entire focus is on the specific investment, the very, very tip of this wobbly, unstable pyramid. And this is exactly how that flawed process works. You start by picking an investment. Then you get obsessed with checking the daily returns. Then you try to time the market. Buy low, sell high, right? And it all comes down to relying on pure guesswork about what's going to happen next. It's totally reactive, it's unstable, and ironically, you end up spending like 90% of your energy on the 10% of things that matter the least. It's this exact kind of reactive, emotional behavior that led the father of value investing, Benjamin Graham, to this powerful conclusion. When you follow that upside-down pyramid, you become your own worst enemy, making panic decisions driven by all the noise in the market. So, if that's the wrong way to do it, what's the right way? Well, it's pretty simple actually. We just need to flip that pyramid right side up and start by building a real, solid foundation. And this right here, this is the crucial turning point, the game changer. We don't start with what to buy. We start by asking, why am I investing in the first place? You know, what is the purpose of this money? Answering this one simple question forms the absolute bedrock of your entire financial strategy. Now, this is the rational pyramid, built the right way from the ground up. And just look at the logic here. Everything starts with your goals. That's the big, wide foundation. From there, you build a plan, which is your blueprint. Then comes your asset allocation, the structure. That's followed by your behavior, which is the discipline that holds it all together. And only then, way up at the very peak, do you finally choose your investments. See the difference? So let's quickly break down those first three foundational layers: your goals, your plan, and your allocation. Getting these three things right sets the entire direction for your money, long before you even think about picking a single stock or a fund. And once you know your why, your asset allocation becomes incredibly simple. For example, if you need the money in, say, less than 3 years for a down payment on a house, you just can't afford to take a big risk. You stick to safe stuff. But if your goal is retirement in 20 or 30 years, well, you need the growth potential you get from things like equity to really build that capital over time. Your timeline dictates your strategy.
Okay, so we've got our foundation and our structure in place, but now we come to the single most important layer, the one that really determines whether your beautiful plan actually succeeds or just falls apart. And that, my friends, is your behavior.
This legendary exchange between Jeff Bezos and Warren Buffett just says it all, doesn't it? Buffett's strategy is famously simple, but it requires a behavior that most people just don't have: patience. We live in a world that wants to get rich quick, but real, lasting wealth, well, that's built slow.
And a huge part of good behavior is understanding the difference between these two words. You see, the market swinging up and down, that's just volatility. That's normal. It's the price of admission for getting long-term growth. Real risk isn't the market going down. Real risk is you panicking and selling at the very bottom, turning what was a temporary dip into a permanent loss of your own money.
So how do you tune out all that noise and avoid panicking? Just remember this simple mantra. The right time to invest is when you have the money. The right time to take money out is when you actually need it. That's it.
It helps you focus on your own life, not the market's daily drama. All right, let's bring this all together. Playing the long game and staying disciplined, it all really comes down to adopting the right mindset.
And I love this analogy. Your portfolio is like a bar of soap. The more you touch it, the smaller it gets. Constantly tinkering, trading, and reacting to the news of the day is only going to shrink your wealth through fees, taxes, and just plain bad decisions. Sometimes the absolute best thing you can do is nothing at all.
So you have to ask yourself, what kind of game are you playing? Is it a frantic T20 cricket match where you're swinging for the fences on every single ball and obsessively watching the scoreboard? Or are you playing a steady test match where the goal is just to stay on the pitch, play with discipline, and let the runs build up slowly, steadily, over time? Real wealth is built in the test match.
And that leaves us with this one final, crucial question. The 99% of investors who fail, they're the ones just watching the scoreboard every day. The 1% who succeed are patiently, quietly building a portfolio that's designed to meet their long-term goals. So the only question left is, which one are you going to be?
Here's the twist. The problem isn't the market. It's the order you're doing things in. Wealth isn't built by doing more, it's built by doing less, but doing it consistently. If you want to be in the 1%, subscribe, because real investing isn't about chasing returns, it's about building a system that works even when you don't feel like it. And the next time you check your portfolio, ask yourself, am I following a plan or reacting to the noise?